Advanced Financial Accounting Excel Practice Problem. In this presentation, we will work a practice problem in Excel related to a consolidation where we have a parent-subsidiary relationship. We have two separate sets of books that we will be consolidating together as if one. The situation will be that's going to be a less than 100% owned subsidiary. We're going to have a fair value versus book value difference. We'll be dealing with the goodwill calculation, and this is going to be year 2. So it's been 2 years since the point in time that the purchase took place, resulting in the controlling interest and the need for consolidations. Get ready to account with Advanced Financial Accounting. Here we are in our Excel worksheet. We have the information on the left-hand side. We're going to put that into the blue area down below and to the right. We got the equity method calculations or journal entries for them. We've got the journal entries that we will be posting for the elimination consolidation entries. We've got the information for P and S, two companies, parent and subsidiary, which we will be totaling up. Then we'll take a look at the financial statements once done. Let's take a look at the information once again all the way to the left. We're saying that P purchased a percentage of S, P parent, S subsidiary, on January 1st, the beginning of the year, January 2000 X0. We're going to be doing the consolidation 2 years later. So in other words, it took place in January X0. We got all of X0 then, and we're looking at X1, the second year. So 2 years of data since the point in time that this consolidation took place. So we're going to go back up top and we're going to say the percentage owned by P, the parent, is 75%. Amount paid upon the consolidation, 108. We're going to assume cash. Fair value of the non-controlling interest, 36,000. Book value of S, net assets, was, I'm saying book value, what it was at the point in time of the consolidation 2 years ago, X0, as opposed to the data we have over here now, this being S's data 2 years later at the end December of X1. So in other words, in this type of problem, the book couldn't do any kind of tricky business to give you this information to kind of let you back into what was the value at the point in time that the consolidation took place, because obviously the assets minus the liabilities are what they would be 2 years later. And we can't just look at basically the equity section before anything closed out to it, because it's been 2 years now. So just keep that in consideration. If it weren't 2 years, then they can have some kind of tricky method to figure that out from the data on the right. Otherwise, they'll have to give you that information as done here. Book value and fair value differences. Fair value of building and equipment above book was 20,000. In other words, if we took a look at the building and equipment over here, not now, but as of the time of consolidation 2 years ago, X0 versus December of X1, January X0, as opposed to December of X1, if we take the building minus the accumulated depreciation at that time, it would have been higher by this amount, by the 20,000. That, of course, is going to have a result in us including it in the consolidation, and because it's a depreciable item, it will also result in depreciation. We will have to calculate it for it in the current year that we're going to be working, 2000 X1, as well as the prior year, 2000 X0, and we'll have to do that every time we do the consolidation, because these are not things that are going to be posted by either P or S companies themselves. Accumulated depreciation, this should be as of the point in time of consolidation, was 30,000. 10 years is going to be the useful life we will use to calculate that added depreciation. The goodwill carrying amount is 2,500. In other words, we're going to say that there was a decline in the carrying amount of the goodwill. Now, we're saying that this decline happened, however, in 2000 X1 or 2000 X0 rather than the current period we're in, which is 2000 X1. So there was a decline of 2,500 that basically happened last year. Now, I want to emphasize that, so I'm going to include that. Why is that important? Because it's going to result in us, we're going to have to calculate goodwill, and then we're going to see what the decline was. And the decline is going to result in an effect on the income statement similar to depreciation, which is going to mess other things up as well. So we need to know, is it a current year thing that's going to be happening to the current income statement, or a loss on the decline, or did it happen last year? This happened last year. So, the purchase took place in 2000 X0. The decline happened at the end of 2000 X0. 2000 X1, it was already declined to this carrying amount, 2,500. So then we're going to do the consolidation as of 2000 X1, which is going to be the second year that we're taking a look at. Let's take a look at the calculation of goodwill. So we're going to calculate goodwill. Then we're going to realize that it declined in value last year, to the 2,500. All right, so let's do this. We're going to say the book value then. They're going to have to give it to us now because it's 2 years out. So obviously in real life, we would get this from, the balance sheet as of the point in time 2 years ago, but they're going to give it to us typically in a problem such as this. And then we're going to say that the fair value of the accumulated depreciation was $20,000. The property, plant, and equipment was $20,000 higher. So just like in prior problems, we're saying, all right, we looked at the balance sheet accounts as of the point in time of consolidation, and we said that the property, plant, and equipment, the depreciable assets, were $20,000 higher. So I'm going to sum that up. That's going to be the fair value at the point in time that the purchase took place. Then we're going to think about our interest being P's interest in S, which we said was 75% here. Now, you would think that you would just multiply that times 75%, but if they give you the non-controlling interest, the fair value of the non-controlling interest as done here, that's what I'm going to take. I'm going to take the fair value of the non-controlling interest at that point. Therefore, the difference then would be the controlling interest, the fair value of the controlling interest. So I'm going to compare, that's the amount that we would assume to be paid, considering the fact that we've revalued the assets and the liabilities and took our portion, the fair value of the controlling interest. If we paid something other than that, it's probably due to goodwill. So that's what we're going to say here. Let's see what we paid for it then. We paid for it the 108, the difference being goodwill. So 108 minus the 84, that's the 24,000. 24,000 goodwill. However, that happened at 2000x0, right? When we did this in January, at the end of 2000x0, it went down to 2,500, and then now we're in 2000x1. So that what resulted in a loss at that point. So now if we look at the equity method, what would happen on the equity method? Notice we can't deconstruct as easily back to the point in time that we actually started this thing, because it was 2 years ago. All we can really do is think about, well, what would happen to the equity method in the current year? So now we're, and obviously in real life, we can go 2 years back and whatnot and think about the equity method, put together a worksheet. But in a book problem like this, we only have 1 year's information. We can't reconstruct the entire account. In other words, I can't reconstruct this entire account. However, I can say what happened to it in the current year. So in the current year, I would say there must have been the investment went up. It's going to go up by our portion of the net income. So I'm going to say negative of, this is standard equity method stuff. And I'm just deconstructing now. I'm not going to post this. I'm just deconstructing. There's the 44,000 net income of S. We're going to say that times our percent. So our percent of that is 75%. So there's our 33. That's got to be part of the increase in the investment. The other side then going to income. So income, which is going to be income from S. So we're going to say income from S. Then P got dividends from S. So I'm going to say P got dividends. So that means that the cash went up by the dividends. The other side is going to be decreasing the investment. This is standard equity method stuff. We're going to record that for the amount of dividends that S gave out times our portion of those dividends, 75%. So they issued 25,000. We're saying times 75% that went to us. So that must have happened this year. That's standard equity method stuff. Then we're saying, now I'm going to account for the equity method things. This is the unusual equity method things, right? That I know is going to happen due to the consolidation to the effects on the income statement. In other words, I know that the building and the equipment increased 20,000 to the depreciable assets. I'm going to record the portion of the depreciation that's going to affect basically the income account as well. It's going to decrease the income account. In other words, I reported our full portion of the income up here. Now I'm going to say it's going to go down by the expense that's not recorded yet, which is going to be the 20,000 divided by 10 times our portion. 20,000 divided by 10 is the added depreciation times our portion, the effect on us, 75%. So this is going to equal the 20,000 divided by 10. That would be the depreciation that we're going to have to add for the year, which we will see in the consolidation process, times our portion of it, 75%. So then there's the debit. Credit, the other side's going to be going to the investment account. So the effect this period on the investment is going to be we would think the 33 increase, the investment 19 here, and the 15. The income then being income from S being calculated to be in this time period, the credit of the 33 and the 1005. So that then, if I go back over here, we're going to say this income, that ties out to our calculation here. The investment account will not, because we're only looking at the current activity that happened in the current year. All right, so this is useful to us because we can at least deconstruct this component when we start to think of this, because that account has to go to 0, so I could see what it's been constructed, and this could give us an idea of what happened in the current year. Similar things happening in prior years as well, of course. All right, so now let's hide these columns from now. I'm going to hide D to G. So I'm going to put my cursor on D. I'm going to scroll on over to G to select those, right-click the selected area, and hide them. So let's hide those. Then I'm going to go to the right. I'm going to make our totals over here. So we have the trial balance for P, the parent, S, the subsidiary. Let's total them up. This is our standard process, so I won't spend a lot of time explaining that. And then I'm going to go on this one. I'm going to copy it. I'm just going to paste this formula. I'm holding down Shift with the down arrow. So I'm going to go all the way down here. And then I'm going to let go and then Control V to post that. And there's we're back in balance. Then I'm going to say, hey, I want to focus in on this account. So I'm going to make it yellow and red. So that needs to go to 0 at the end of the day. That's one of our major check figures, as is this account. That needs to go to 0 at the end of the day. So I'm going to keep those in place here and mark them off. Now let's do our deconstruction here. It's going to look very similar. We're going to first be removing kind of like the equity accounts for S, and then we're going to think about the changes that took place to the balance sheet, which include the building and goodwill. Then we're going to start thinking about the changes that the effects on the income statement that could happen from there, and we'll go from that point forward. So again, you could break this out in different ways, but there's pros and cons to it. Just so you mess around with it, break it out different ways, mull it over. So I'm going to first pick up the investment in S. Now, I'm not going to put the amount yet. I'm going to use this as the plug, but we will calculate it later as well. But I like to just think about that one because that's going to be a credit. I'm not putting debits on top, of course. Same process I've seen in the past. We have seen in the past. I'm going to go down here and then remove the equity of S. So this is standard. So we've done this. This has been since all these consolidations. We're going to say the common stock. I'm going to pick up the dividends. And then I'm going to pick up the retained earnings and then the dividends. And I'm just going to do what I got to do to remove S's portion. So the common stock is a credit, so I'm going to debit it. So I'm going to say negative of that 60,000. And then retained earnings is a credit here, so we're going to debit it. So I'm going to say negative of that 48,000. And then the retained earnings is a debit, so we're going to credit it. So I'm on the credit side. We're going to credit it for that 26,000. So there we have those items. Then we have the income down here. So income from S. We got to remove that account. Now, but we're going to post it to that account, but we're removing kind of like the equity. So that we removed this. We're going to remove the income, which rolls into equity, which is the net income, which is the 44, the full income. Even though this is reporting our portion of it, or P's portion of it, as well as taking into consideration the difference due to a consolidation difference, like the depreciation's effect on it. So for this journal entry, we're going to say, all right, I'm going to post it to this account, but I'm going to post for now the whole portion, or 75% P's portion of it, but I'm not taking into consideration the change that happened with the added depreciation that will result from the increase in the building and the equipment. Okay, so hopefully I didn't confuse anyone with that. We're going to say negative of the net income. So I'm going to pick up the net income down here, the full 44, and then I'm going to multiply that times the 75%, our portion of it. And so that is 33. So that doesn't match what is here because we didn't take into consider, we didn't change it for the change in like the depreciation that's not on the books of S yet, because it's going to be part of the consolidation process, but will affect the income statement. All right. So then we're going to be, we've kind of pulled out the 75% portion of this, equity portion here. Now we got to think of the other side, the non-controlling interest, the 25%. So we're going to, okay, now I got to pick up the 25%. So I'm going to pick up the non-controlling interest on the income statement, which is generally pretty straightforward because we picked up 75% here. So the other 25% is going to be the other side, right? So the non-controlling interest on the net income, I could say, well, this must be then negative of this amount down below, the 44 times, and I'm just going to do it with a formula, brackets 1 minus the 75, which would be the 25, the non-controlling interest portion. And so that's the 11s. And then, of course, the sum of those two would add up to the 44. And then I've got this amount here, which is going to represent the non-controlling interest of basically balance sheet accounts. So I'm going to say, all right, that's going to be equal to the non-controlling interest. So you'd think of the net assets. Well, what are the net assets? They're going to be assets here minus the liabilities, the 126, or you can calculate it as the entire equity section being the 126. So I'm going to say then the 126 times the non-controlling interest portion, or the 25%, which we can calculate as equal to the sum of the assets minus liabilities, and then times, I'm going to say brackets 1 minus that 75. So we can use our formulas times 25% in essence. So there we have the 31, and it should be a credit, by the way. Sorry about that. It should be over here, a credit. And I'm going to double click on it, and I'm just going to put a negative in front of it so it'll flip the sign. So I took assets minus the liabilities, multiplied times the 25%, and then made it a negative for the credit balance. And then I'm just going to paintbrush this back up to fill in that the hole that was there. All right, so then we have that. Now I'm just going to pick this item. If I select the negative sum, that should be, I should be able to plug that in here. Or notice this represents basically the net assets times the non-controlling interest, 25. The investment account is what we're going to reduce. That's where the other side is going to go, which is going to be the net assets times the 75%, right? So this is going to be the net assets minus liabilities, the 126, or all of the equity, the 126 times 75%. So I'm going to do this in the credit side this time, negative sum of, and I'm going to be picking this up now. We're going to say all of this, assets minus liabilities, close it up, times the 75%. So 75%, so there we have that. And that should do it. If we highlight this whole thing, we should be in balance back to 0. That looks good. So in essence, we took off the equity, the equity section, which has a net credit balance, right? All of the equity here has a net credit balance of the 126, and we basically net debited it, right? We took off the common stock, the retained earnings for S, the dividends we took off with the credit, and then basically the income, and then the non-controlling interest portion of it, that adds up to the 126, right? And then we broke that up between the other side going to the investment, the controlling interest, which has been posted here using the equity method, and then the non-controlling interest, which we added a new equity account for there. Okay, so now we've done that. Now we have to account for the fact that we had changes in the assets and the liability, changes in the balance sheet account, and then the effect of those changes that happened on the income statement as well. So we know that the building, for example, went up. So building went up at the point of purchase. So we're not talking fair value now. We're talking about fair value 2 years ago when this thing was purchased was $20,000 higher. So we're going to depreciate the cost as of the point in time the consolidation took place. And then we know that the goodwill went up. It also got impaired, but I'm going to do this in 2 parts so we can kind of see it, right? So we could see like the goodwill went on the books of the 24,000, and then it became impaired. Now you could kind of net those out if you want, but I think I'm just going to post both sides. The impairment didn't happen this year, it happened last year. But I just want to post them both so you can kind of see what happened, right? The impairment happened last year. And then the other side of this, like this is the assets going up total. Now the other side needs to be broken out between the amount that goes to the change in the parent versus the subsidiary, which are once again 75% parent going into the investment account, 25% subsidiary now going into the non-controlling interest of the net assets, because we're on the balance sheet basically side of things. You can think of it like that. We're going to sum these two up and then allocate them 75-25. So I'm going to do this negative sum of these two and close it up times, and we're going to multiply it times the 75 going to the investment account for the controlling interest. So then I could do the negative sum plug formula, or I could do the same thing, or just take the sum of just these two, multiply times the 25, which I want to do to emphasize that 25%. I'm going to calculate it as 1 minus the 75. So then we'll pick that up, and that should be in balance here. So we're going to say, all right, does that balance? Yes, that looks good. Okay, so I haven't posted anything yet. So let's post both of these at the same time now. So let's go to the investment account. So let's go to the investment account. And I'm going to say, all right, this one's going to go down by the 94.5. It's not going to go down to 0 yet, but that's okay. We're not done with it. I didn't expect it to go to 0. It would have been nice if it did, but that's okay. And then we're going to go to the common stock. So common stock has a credit here. We're going to debit it. Common stock up here. I'm in P14 equals the 60,000. So we'll pick up the 60,000. Then we have the retained earnings. So retained earnings. And we're going to post that one. That's going to be equal to the 48,000. Then we'll go into the dividends. So dividends down here, dividends up top. We're going to say that's going to be equal to the 26,000. So notice all of these, we basically cleared out S's portion. So here's P's portion, here's S, here's the total of them. We removed S's portion, basically bringing us back to P's portion here, which matches P's portion here. All right, then we're on the income from S. So income from S down below. So here's the income from S. That's one that we hope to go to 0. It's not going to be done yet with this one, but we're on our way. We're not, we'll figure it out. So there is that one. And then we've got the non-controlling interest in the net income. It's going to be down here. Non-controlling interest in the net income is going to be equal to the non-controlling interest in the net income. There it is, the 11. Okay, and then we have the non-controlling interest in the net assets. Finally, non-controlling interest in the net assets. Lastly, and that's going to be the 31.5. All right, so that should put us back in balance there. Then we're going to record this one. So the building and the machinery should have gone up. So let's go on over to that, and P7 equals an increase in the building and the machinery. Then we have the goodwill. The goodwill is going to be going up, so let's do that. Goodwill is going to be in P9 equals, we will increase the good old goodwill. And then we're in the investment in S, so let's go on down to the investment in S. So we are in P19, F2 plus F2. Picking up I'm sorry, this is the wrong account. Apologize. That's the income. We want the investment up top on the balance sheet side of things. So I'm in P10, F2 plus F2. We're picking up that 33,000. And then the non-controlling interest in the net assets, which is in P17, F2 plus F2. We're going to be picking up that 11,000. So there we have that. That should be putting us back in balance. So we're back in balance again. Okay, so now let's think about the fact that the goodwill was impaired. So this goodwill was impaired. Now, what you gotta remember here is the question is, when was it impaired? Because it's 2 years later. So did the goodwill if it got impaired this year, then we're gonna have to write down either way, the goodwill's got to go down to the impairment amount, which I think was what, this 2,500, is that it? 2005. So that we know is going to happen. We're going to decrease that with the credit. Then the debit is, if it happened in the current year, would be a loss down here. So it would be goodwill impairment loss. But if it happened last year, then we're not going to affect the income statement. It should be up top, and it's going to be affecting the difference between the non-controlling interest and the investment. So it happened. So in this case, it didn't happen this year. So it's not affecting the income statement. It's going to be balance sheet affected accounts. So I'm going to record this one. And I'm just going to put the credit on top here. I know goodwill is going to go down. It's going to be a credit. So I'll just record that first. Because I'm going to build it the way I know it. I'm going to say, I know goodwill is going to go down, and it's got to go down to that 2,500. So it's going to be 24,000 minus 2,500 is what it needs to go down by. Therefore, I'm going to say negative brackets of the 24,000. Let's pick up this number. If I pick up that number, it'll cause a circle reference when I post it, so I can't pick that one up. But I like to use formulas when I can, so I'm going to pick up the goodwill up there, minus. And why do I like to use formulas? If I go back to this later, formulas are a lot easier to look at and figure out what happened. If you have someone else reviewing it, formulas are a lot easier to look at and figure out what happened. So I'm going to then say there's the 21,500. And then the other side, I'm going to break out between the 75% in the investment account. So the investment in S, and then the other side go into the non-controlling interest. So not the income statement, right? And that's going to be 75% of this. So I'm going to say negative this times 0.75, and then negative of this times 0.25. Note that I did not calculate this correctly. I put minus 0.25, which obviously is not quite right here. So it would be times 0.25 or times 1 minus that 75 up top. I'm going to leave it here for now because it's going to move forward to it. So you can either fix it now, or you can go back and fix it with us at a later point. This is, of course, once posted, going to put us out of balance by that. This is going to be 1625. So again, you could fix it now, or you could push forward and we'll fix it after the next journal entry. And you could have just done the negative sum formula or adding these two up for that second one. So let's post that out now. So the goodwill is going to be up top. We're going to be up top in the goodwill. So that's in P9, double clicking on that, going to the end of it. Plus, we're going to go into that 21.5. 21.5 brings it down to the at 2,500. Then we have the investment in S. So the investment in S is going to be here in P10. Something's in it. So I'm going to say F2 plus F2. Scroll on down to that 16,125. And then we have the non-controlling interest down below, the non-controlling interest in the net assets. Something's in it in P17, F2 plus F2. We're going to pick up that 21,500, the 21,500 there. All right. Now we're going to be thinking about the next change that's going to be happening, which could happen, again, last year. What happened last year with regards to we took care of the goodwill. We had the depreciation, accumulated depreciation for prior years. So let's deal with that for the prior year, and then think about the current year's, accumulated depreciation. So in the prior year, you had a similar type of thing happening here. Well, we had the accumulated depreciation is going to be increasing for however many years have passed. There's 1 year in the past, and then we'll think about the current year's depreciation expense. So this accumulated depreciation, I'm going to increase it in two parts. 2 years have passed since the point in time that the consolidation took place. I'm going to think about it as, again, the prior year first, or prior years if there were more than one, and then the current year. So that means, again, I know that this is going to be a credit, but I'm going to put it on top because I want to think about it first. So I'm going to say, all right, accumulated depreciation is going to go up for last year's, depreciation. That was an increase, so it went up by 20,000, and then 1 year has passed before this year. So I'm going to say, all right, this is going to be equal to then and it should be a credit, so I'm going to put it on the credit, negative of this 20,000 divided by 10. 20,000 divided by 10, and that's going to be the 2,000. That's how much it went up, again, 1 year, I'm going to say last year. Now, last year's increase isn't going to be a debited depreciation expense, because last year closed out. So it's going to be, once again, a breakout between these two accounts, right? So it's going to be a breakout between the investment in S portion, 75, and the non-controlling interest, 25. So now I'm going to say negative of this number times the 75%, and then negative of this number times, and then I'm going to say brackets 1 minus, and we'll pick up the 75, 1 minus 75, or 25%. So there we have that. Now we're going to go ahead and post that one out. So now I'm going to say, all right, accumulated depreciation went up for last year's depreciation expense. So I'm going to say this is equal. That's going to increase. That'll bring us up to January of the current year of that. And then we have the investment in S. So the investment in S must have accounted for that using the equity method. So the investment in S is going to be affected. I'm going to say F2 plus F2. And that's going to be picking up the 75% of that, or the 1,500. The other side then going to the non-controlling interest for the assets, right? Because it was last year, so it's not in income. So F2 plus F2 for the I forgot the other F2. F2, and that's going to be the 500. So there we have that. That should then put us back in balance. Once again, it did not. So what happened? So I think I went back and put this in the video so you're aware of it now as it happened, but this account is off. So if I highlight this, it doesn't add up, and I could say, oh, well, it's got to be something with that journal entry because it looks like this number. This number is off, and it should be times 0.25, not minus. So I'm going to say times, and then I'm going to calculate the 0.25 by saying 1 minus, and this is probably what threw me off here, is trying to do this calculation. But 1 minus the 0.75, so we're always, tying into the numbers as much as we can. That should put us back in balance then. So this is what that one should look like. So that puts us, that's in balance. So that looks good. Now these two numbers are at the 1.5 and the 1.5. So that looks good. Now what I'm going to do is say, okay, now I'm going to record the current year's depreciation. And I'm going to do that just like a normal depreciation type of journal entry, because normally you're going to say, all right, now we had this year's depreciation, which would normally be calculated as, depreciation expense, and then accumulated depreciation for the current year. So this was going to be affecting the income statement as well. It's going to be the same calculation for that 2,000. So I'm going to say this is going to be equal to, we're going to say it's the 20,000 divided by 10. So there we have that. That's it. I like 10, like there's something else, but no, that's it. And so there we have that. Now, once we affect something on an expense here, we know that then we're going to have this breakout that's going to be happening between the non-controlling interest, because we calculated this non-controlling interest portion, not based on that adjustment. So let's record this first. So we're going to say depreciation expense is going to be going up. So we will increase the depreciation expense. Then accumulated depreciation, we're going to go up top to accumulated depreciation is here in P8, F2 plus F2, scrolling down to accumulated depreciation, and there we have that. So now we've increased accumulated depreciation for the 2-year time period affected for the 4,000. One of those 2 years being the current year, represented by the 2,000 in depreciation expense, the other being broken out between the investment and the non-controlling interest. Now we're going to be thinking about, okay, what happens if I affect the depreciation, because now that changed the net income calculations on which we broke out our, basically our first journal entry. So we're going to say, all right, well, that's going to have an effect here in terms of the controlling interest and the non-controlling interest. So we're going to say then that the income, let's say this account, we need to adjust the income from S needs to be adjusted, and let's actually put it on the bottom. So because this needs to be a credit, so let's put this on the bottom. Income from S needs to be adjusted, and then the other side is going to be going into this income account. We can see what the amount is now, right? It's going to be that 1,500, and it's going to be 4 to calculate that. The 2,000, this is where it's coming from, times the 75%. 75%, we'll pull out that breakout. So I'm going to say 75%. So there we have that. So now I'm going to say, all right, so that should take these two down. So the income from S, I'm going to say F2 plus F2. And we should be able to bring this down. And that'll bring it to 0. That's what we wanted. And then the other side's here in P10, I'm going to say F2 plus F2, and we will bring it down. So the investment in S, bringing that down. So there we have that. Then the other side is going to be dealing with this non-controlling interest. It's also not correct due to its portion, which is 25% or 500. So we're going to say that non-controlling interest for the net income, we need to break that out between here and the non-controlling interest for this item, the NA. And this is going to be for that 2,000. And I'll do it the same way times, I'm going to say brackets 1 minus. I'm going to be picking up that 75%. And so there we, oh, I didn't close it up, but there you go, 500. And so there we have that. So let's record that out. We got the non-controlling interest in NA, so net assets in P17, F2 plus F2. Scrolling on down to that 500, so there's that 500. And then we have the non-controlling interest in net income. So we are in P26, F2 plus F2, scrolling down to that 500. So there we have that item. Note, it might be useful also to kind of break this out on just S's side. So in other words, if you look at the net income, the 44,000, we made an adjustment to depreciation that you could see up top. If you want to just see the effect on S's books, right, you'd say, well, that's going to be a debit to depreciation, and then that would decrease the net income to the 42. And then if you broke the net income now adjusted 75.25, you'd get the 31.5 and the 10.5, right? That 10.5 now matching, of course, the net income, the non-controlling interest. So in other words, if you did a kind of adjustment like this, you should be able to break out 25%, which should be kind of another check to match out against that non-controlling interest that should be reflected here. Okay, so those are the main components. Now let's do the accumulated depreciation entry we typically do, which is going to be reducing the accumulated depreciation or consolidating or breaking it or putting it into the book value of the building as of the point in time 2 years ago when the purchase took place. So this is standard stuff we've seen in the past. I won't spend a lot of time with it. I'm going to be debiting the accumulated depreciation. So I'm going to say accumulated depreciation will then be debited. And then we're going to be crediting the building. So we're going to credit then the building like so. And the amount, they're going to have to give it to us this time because it's been 2 years. So we can't really just back into it in any way with the data that's been given. So it'll have to be in the data source, which we said was the 30,000. 30,000 there. So then let's go ahead and post that. Again, I'm not going to spend a lot of time on it. We've seen this in the past. Accumulated depreciation, I'm in P8, F2 plus F2. Scrolling on back down to that amount, which is going to be the 30,000 there. And so there it is. And then we're going to go to the building up top. So the building and say F2 plus F2. Scroll on down and we will pick up then the other side, which is going to be the other side, the 30,000 here. So there we have that. So that looks good. Now we're going to take our ending numbers over here, which should be in balance now, and just do a quick financial statement. I'm going to throw this in there fairly quickly. Of course, our things that we're concentrating on are just really this non-controlling interest down here for the balance sheet, and then the same for the income statement. So it's pretty, you know, it's not too difficult to think about how that's going to break out, but let's take a look at it. And so I know this is a long video, but we're going to say, okay, cash is going to be this. I'm just going to copy and paste that down, paste it down to the Goodwill, and that should look good. I'm going to then say that line up as it should. Yes. And then I'm going to say total assets is going to be the sum of, just going to highlight these. I'm going to put in an underline here just for formatting purposes. Then on the liabilities, I'm going to be picking up a negative of this number and the negative of that number. And then I'm going to put an underline on that one because I think it should be there. And then, oh, no, I was wrong because there's a note payable. So let's say this one is negative of the note payable. Then let's remove the underline, which is totally wrong there, and then sum this up. There's our liabilities. And then we're going to go to the stockholders' equity. Here's where the new thing is, where we have this controlling interest and non-controlling interest. So the controlling interest, we're going to say, all right, controlling interest, that's going to be negative of this, which you can see is basically P's interest, right? Because we removed the equity section for S in essence, right? And then I'm going to say, all right, and then the retained earnings is going to be, again, kind of like P's portion. And then, and notice, just so you know, like if I go back over here, P's assets minus liabilities, which equals kind of like the equity section, is reflecting the fact that one of the assets here is the 108 375, right? So this equity is reflecting their portion, 75%, you know, I'm using the equity method. Okay, so then if I was to sum this up, so I'm going to say then let's sum this up. And there we have that. And then we got like the non-controlling interest here. I'll just put that right below here. That's going to be the 36,125. 36,125. Let's get a underline on this if we could, and let's get an underline here, and then we'll sum that up. That's going to be the total equity. So there's the total equity, and so then that again, that's the new thing, right? So that's the new thing. Total equity. If I was to sum everything up, that doesn't work. Why? Retained earnings. Retained earnings is wrong. Hold on a second. Retained earnings has to be negative, and you could pull this from the income statement obviously, but it's this minus this, and then minus the sum of all of this. It's everything. I'm not going to include the non-controlling interest, and that's going to be the 183,375. That should be it. Let's see if that puts us in balance. So this is going to be the liabilities plus the equity. That's the 794, which matches the 7094 up there. So that looks good. So I'm going to underline this, double underline. We'll double underline this. We'll put a single underline here, and that looks good. Now, I note that I like to do the balance sheet first to figure this retained earning, and you can get that. We'll see it, we'll do the income statement too and check this out, and you can get it from the financials. We want to double check that number in any case. So then I'm going to hide these cells so I can just look at the income statement. So let's hide these. I'm going to right click and hide them. And let's just put the income statement together real quick. The new thing being, down below with that non-controlling interest thing. So the revenue, I'll put that on the outer column. I'm going to say negative of sales up top. So negative of the sales. And then I'm going to say the expenses. Let's go to the expenses, cost of goods sold. I'm just going to bring that inside. So we'll have our inner outer kind of subgrouping. Cost of goods sold, and then I'm going to copy that, and I should be able to paste that down to the other. So I think that's right. And then I'm just going to sum this up in the outer column, summing that up in the outer column. Then I'm going to underline this. Let's see if we can go ahead and underline that. I think everything's working as it should thus far. We'll see in the net income. And then I got the consolidated net income, which is going to be equal to, this is kind of the tricky part here, because it's not including one account. It's not tying out to this bottom line number here because it's not including this number. In other words, it's only tying out to the revenue minus the expenses, the 102,000. Then we're going to be adding to that the income to non-controlling interest, which acts kind of like an expense, but we're going to break it out in that little subcategory of that 10,005. And then if we took this 102 minus the 10,5, we get to the 91.5, which is being reflected down here on our trial balance because we kind of broke this amount out as kind of like an expense. All right. So then we're going to go to the consolidated retained earnings. So we'll take the beginning retained earnings, which is going to be just like a normal financial, the negative 127,875 because it hasn't had the rest of the accounts closed out to it yet. Then we're going to say the income to the controlling interest. The income to the controlling interest was equal to that 91.5, which of course is the same as the 91.5 down below. And then we have the dividends. So I'm going to say dividends is going to be the 36. And then I'm going to say this equals this minus that. And that should, I'm sorry, this should be equal to the non-controlling interest. Let me do this again. This should be equal to this plus this minus this. And I think I have a subtotal in there for a reason. So let me do that one more time. I'm going to delete this and let's subtotal this equals the sum. Add those up. Same thing, but then this minus this. Sorry if that was confusing. But that's going to be the retained earnings, which we already calculated, you'll recall, which was this number, and then skipping the non-controlling interest in the net assets, holding down control, these numbers. There's the 183, 375, which is in essence what this report is doing. If I then unhide, holding down from Q to W, selecting those columns, right-clicking the selected area, unhiding them, then we could see our key numbers here, of course, being assets equaling the liabilities. We could see the net income here, basically, or the income to the controlling interest reflected on the consolidated retained earnings statement, the ending balance in retained earnings tying out to what is on the balance sheet.